Gold doesn't panic, power does. Autonomy of a safe haven reflexes in an age of fracture. The story never begins with gold, it begins with silence. Before the opening bell, before the headlines, before the first analyst publishes a note, the financial district is already awakened. Lights burn in empty towers, screens glow in vacant trading rooms. The market stirs before society understands what's happening, and this is how economic stress system first appears, not in crowds but in terminals, not in speeches but in numbers. Gold doesn't rise because people are excited, it rises because something else has shifted beneath the visible order. When geopolitical tensions fracture the global stability of a currency, the first response is rarely dramatic. There are no immediate collapse, no cinematic explosions in capital markets. Instead, there is a reallocation, quiet, mechanical, funds move, allocations adjust. The institutional reflex activates. The central bank reassesses reserves, sovereign wealth funds rebalance, large hedge funds tail risks. Gold doesn't need to advertise itself, it waits for the moment when trust thins. Then it absorbs the doubt. Power rarely transfers in spectacle, it transfers in situations, behind closed courtroom doors, in arbitration chambers, in emergency central bank meetings, in decision when decisions are made that reshape the capital flow. The microphones outside may remain silent, the press may arrive too late, narratives chase events, but events are decided everywhere. Goals thrive in this latency. It benefits the gap between causes and comprehension. The global map looks orderly from a distance. Borders are drawn, trade routes are charted, alliances are documented, yet beneath that surface lie fault lines, economic rivalries, energy dependencies, frozen assets, sanctions, contested elections, reduced expropriations. When all of these fault lines lights up, the stress propagates through the system. Gold is not reacting to the event double earn. It is reacting to recognition that architecture of stability is thinner than assumed. Safe haven demand is not emotional, it is structural. Investors do not buy gold because they are afraid of headlines. They buy gold because gold sits outside counterparty risks. It carries no earning promises, no default risk, no boardroom, no sovereign liability. When trust in institution trembles, capital seeks something that doesn't depend on institutional integrity. Gold's appeal is not ideological, it is absolutely mechanical. Markets respond faster than comprehension. Tickers spike, futures climb, ETFs register inflows. The speed of reaction outpaces the narrative being formed. Analysts explain after the fact, strategies build frameworks, economists debate causality, but the trade has already occurred. Goal surge is not a prediction, it is a recalibration. There is always an illusion of calm after the first surge. Charts flatten, volatility compresses, commentators speak of stabilization, yet beneath the surface positioning has changed, capital has moved, risk has been repriced. The skyline may appear steady, but storm clouds gather beyond the horizon. The delay between cause and consequences is the most dangerous interval in finance. Gold understands delay, it waits through cycle. The awakening of gold is not about creation, it is about revelation. A gold bar in a vault is the end state of extraction, refinement, storage, and trust. But the ore embedded in rock is the origin. Value was always there, it required pressure, effort, permission to be realized. In markets, stress functions like a geological force. It exposes what was embedded in a system long before anyone paid attention. The scale converts price into power. For major producers, every incremental rise in gold price magnifies margins. A massive open pit mine at sunrise, with tiny trucks crawling along terraced walls, represents more than industry capacity, it represents leverage to the price of gold. When gold doubles, revenue doesn't merely increase linearly, margins expand disproportionately. Scale transforms volatility into dominance, optionality in a different archetype. Vast mountain ranges marked with survey stakes symbolize potential that has not been activated. Underdeveloped assets are dormant leverage. They wait for price threshold, regulatory approvals, financial windows. When gold mines rises sufficiently, what was once uneconomic becomes viable. The mountain doesn't change, the price does. Optionality is patience institutionalized. There is also the ghost. Abandoned industrial sites overgrown with vegetation testify to expropriations, political shifts, and failed projects. Assets may die operationally, but claims persist legally. Litigation becomes a parallel battlefield. Legal documents stacked beside gold bars illustrate a harsher truth. Law is delayed force. Arbitration averts enforcement actions, asset seizures. These are mechanics through which past value attempts to resurrect itself in new form. Capital flow itself is silent warfare. Shipping lanes, blowing on dark global map, reveal how trade networks function as arteries of power. When friction enters those routes, sanction, blockades, ceases, velocity slows. Containers sit idle under floodlights at a port represent more than logistical delay. They represent constrained liquidity, disrupted cash cycles, deferred revenue. Friction kills velocity. Gold thrives when velocity slows. The illusion of calm often follows volatility. A stock chart flattened after a violent move suggests equilibrium, but equilibrium in markets is rarely natural. It is negotiated. Positions are unbound. Risk is transferred. Central banks signal intervention. Behind the calm surface, balance sheets are being fortified. Hedging is being layered. Gold sitting in vaults absorb incremental allocation quietly. Empty trading desks with screens still capture another truth. Fear lives last. Even after positions are closed and headlines fade, the memory of instability lingers in institutional decision making. Risk committees remember, compliance departments remember, central banks remember. Gold is a physical embodiment of that memory. Gold as power memory is a crucial distinction. It is not productive in traditional sense. It yields nothing. It manufactures nothing. Yet it holds memory of every currency crisis, every war, every asset freeze, every foreign sovereign default. It is a record of systematic fragility encoded in metal. Central bank vault corridors, empty of people yet filled with bars, are archives of trust preserved against future doubt. Gold doesn't promise growth, it promises endurance. A single gold coin resting on cracked stone conveys a simple hierarchy. Ideology fractures, stone spills, system strained, but the metal remains. Endurance over ideology. In moments of systematic stress, that hierarchy becomes visible. When the vaults when the vault door closes, they do not announce themselves. Power doesn't perform theatrics. Yet, at its deepest level, it consolidates quietly. It rebalances exposure. It adjusts reserves. It redistributes risks. The closing vault door symbolizes the system treating, retreating into the oldest form of scrutiny. The fade to black with a faint metallic reflection is not is not an ending. It is a return to waiting mode. Gold doesn't require constant attention. It waits through expansions, contractions. It sleeps in bull markets. It awakens. It fractures. Its cycle is tied not to growth but to doubt. In an age of geopolitical tension, asset freeze, currency weaponization, and accelerating technological competition, gold's relevance is not nostalgic, it is structural. The freezing of sovereign assets is in one region reverberates across central banks globally. Nations observe, nations observe, adjust reserves. Trust becomes conditional, gold becomes insurance against the politicization of currency. The interplay between monetary policy and gold further deepens its significance. When interest rates fall, the opportunity cost of holding gold declines. When central banks expand their balance sheets, currency dilution concern rises. When real yield compresses, gold relative attractiveness increases. These are not emotional traits, these are mathematical responses. Yet, mathematics alone doesn't explain gold's persistence. Its durability lies in its independence. It doesn't depend on an issuer, it doesn't rely on governance, it doesn't require performance. It simply exists in a world increasingly structured around digital promises, leveraged derivatives, and physical existence carries a symbolic weight. The market may oscillate between enthusiasm and complacency. It may alternate between volatility and stagnation, but beneath those oscillations, the deeper architecture of trust is constantly reassessed. Gold operates at the architectural layer. It is not a headline trade, it is a structural allocation. When geopolitical events erupt, markets may initially overreact or underreact. Analysts debate duration, magnitude, and contagion, but the first order reaction often marks second and third order effects. Supply chains adjust, reserve composition shifts, alliances strain, currency corridors tighten, gold responds not only to immediate shock but to anticipated ripple. The narrative that gold is archaic misunderstands its function. It is not a relic, it is a fallout. Modern finance is a network of promises. Gold is a non promise. It in moments when promises are questioned, the moment when promises gains value. Thus, the awakening of gold is not dramatic, it is procedural, triggered by recalculation, it is sustained by memory, it is reinforced by institutional behavior, it fades when confidence is abundant and resurfaces when confidence is scarce. The final image remains simple, a coin on cracked stone, a vault door closing, a faint reflection in darkness. Systems will continue to evolve, technologies will advance, currencies will digitalize. But when stress tests the architecture of trust, the system reaches backward before it reaches forward. Gold does not panic, it doesn't rush, it doesn't speculate, it waits. Power, when threatened, is the entity that moves.